Good morning and welcome to our breakfast seminar, where today we'll be going through yesterday's budget, looking at some of the tax and business consequences of what the Chancellor told us yesterday. My name's Andy Gibbs. I'm the Group Technical Manager here at Tax Assist, and I'm joined today by Diane Deller, who is our Senior Tax Manager. As I said, we'll be covering what the Chancellor spoke about yesterday in the budget, covering the main tax consequences. But before we start, just a little bit of a word about us. Tax Assist are a national firm of accountants, and we're here to look after the interests of small business owners and the general business community. We have shops across the UK where our accountants are here to help you and help look after all your business and tax needs. We'll come on to a summary of the tax consequences in a minute, but the backdrop to the budget was obviously the recovery from the COVID-19 pandemic and the consequences of dealing with such a large economic shock. Of course, the good news is that most of the worst news of the pandemic, on the economic front at least, is over. And there was some good news in the sense that the OBR, the Office of Budget Responsibility, was advising that the economy is performing better than expected, and economic growth was revised up. As well as that, unemployment, which was expected to peak at a much higher level, is now estimated to only be peaking at 5.2%. So there were some good positives spoken about by the Chancellor in terms of the overall economic picture. It's probably true to say that the overall content of the budget on tax was pretty was quite small, but there have been a lot of pre-announcements. I think that's really what the overall feeling, wasn't it, that we felt, Diane, yesterday.
Yeah. Morning, everyone. So as this slide refers to, there was some stuff announced earlier this year. So there was a budget in March 2021, and there was an announcement about increasing corporation tax. That doesn't come in until April 2023. The risk is, with a lot of things that are announced well in advance, that you get comfortable about the fact they're coming but forget the impact of them. And that one will, for professionals, mean a return to marginal relief calculations, which will always enjoy, but more importantly, it means a potential increase in tax up to 25% if you're over the limit of 250,000. So there's a marginal, you're a lower rate company still keeping the 19% if your profits are less than 50,000, but for everyone in that gap, the 50 to 250 bracket, there's a marginal rate that will apply. And the risk is that we overlook that now, and there's some proliferation of subsidiary companies that are all active in a group, for instance, and those limits all get divided up. So that's something to think about in terms of planning ahead. We know that the personal tax thresholds were frozen, and also the new health and social care levy was introduced at 1.25%. I'll talk about that briefly a bit further, but I did hear a quote yesterday that for all the fact that this latest budget was very much flagged as supporting the economy, supporting people, supporting families and the lower paid, in actual fact, over the course of the last year, as a result really of the measures in March 2021, the government has raised more tax than any government since 1993. So we do need to be wary about some of these changes and take action where we can to sort of plan around some of those things. Thankfully, some things that we had feared didn't happen. I suppose realistically, we probably knew that there wouldn't be an introduction to wealth tax in place of inheritance tax, because at the moment, the economy, everybody really, the people can't cope with too much more change. We've been through a lot, so that didn't happen. Business asset disposal relief didn't disappear, which was again an immense relief to people about to sell shares. Pension relief, we thought maybe that would get restricted to basically taxpayers only, but because that's a fairly easy way to raise money, but that didn't happen either. And the IR35 changes, nothing more was added there in terms of making workers more on a par, classification of people who are workers on a par with employees. So all those were kind of good things, because it was, as Andy already said, a fairly simple budget in terms of tax. So the health and social care levy, which has been added to national insurance initially, is going to apply from April 2022 at 1.25%. That's 1.25% for employees and employers, and it applies to the employed and self-employed. The government was keen to point out that 40% they think of small business owners won't actually see a rise in their employer contributions because of the employment allowance, but obviously that still leaves 60%, if you will. Another change early on was the increase to dividend tax. So that was introduced originally at 7.5%, it's gone up to 8.75%, and the higher and additional rates were also increased by 1.25%. So if you're an additional rate taxpayer paying at 45% on your income, when it comes to dividends, you'll be paying 39.35%. A very catchy amount, I must say. But anyway, those two are both being increased. Back to you, Andy.
Thanks, Diane. I think it's true to say that a lot of the thunder of the budget in terms of tax was already stolen, really, in many ways, because there'd been a lot of leaks, and it had also been widely leaked that there was going to be an increase to the national living wage. That's going up by 6.6% to £9.50 an hour, and that rise will come in from the 1st of April 2022. There'll also be some increases for apprentices and young people as well. Basis period reform and making tax digital. The Chancellor did take the opportunity earlier in the year to announce that the making tax digital reforms for income tax, which will affect the self-employed and sole traders, they were due to come into effect from April 2023, and they were delayed earlier in the year. So there was already an announcement that these would be delayed till April 2024. And there are some complex rules which apply to sole traders when they start business, and they don't have a year end, so where they draw their accounts are lined up with the tax year. So if you draw your accounts as a sole trader to 31st of March or 5th of April, these changes won't really affect you in terms of the basis period rules. But if you have a year end, say December, or an April year end, you may need to look at these. So there is going to be a reform of these basis periods, but there is still some time to plan. The new rules will come into force from the 6th of April 2024. So this will probably not affect the vast majority of sole traders, but it will affect some. And there was also some confirmation on the MTD front, on the digital front, of how it would be rolled out. As we said, sole traders and landlords where their trade income or their property income is over £10,000, they're going into making tax digital from 6th of April 2024. Delay of a year from what was previously announced. But general partnerships, so if you're a partner in a partnership, they will actually come in from the 6th of April 2025. And for other partnerships, so limited liability partnerships and partnerships with corporate partners, they will follow a little bit later, and it hasn't yet been confirmed when they're coming into MTD, so we'll just await further details before we can explain the rules a little bit more to those partners.
So R&D tax credits. R&D is an area we deal with a lot in our tax consulting team. So my ears always prick up when they start talking about R&D. And the Chancellor made much of supporting innovation and keeping expertise in this country. And there are some quite large numbers that are going to be pumped into various initiatives. But then on the side of the tax, on the tax front, what sounded like a positive move in that, yes, it has to be good to concentrate efforts in R&D in the UK, could actually have quite a negative impact on claims going forward. This is another thing which we don't have a great deal of detail about. So at the moment, we're speculating. If you have employees in your company that are carrying out R&D, and it has to be in a company, then you can claim for the costs of those employees where they are dedicated to R&D work. So when I say dedicated, I mean if 50% of their time is spent on R&D, you need to claim 50% of their salary. If you don't have enough employees though, and you use subcontractors, you can also claim for subcontract labour, and you get a slightly reduced rate because those are not individuals you're paying PAYE and NIC on, I guess is the thinking really over that. So you get 65% of their cost. What the Chancellor seems to be implying is that if there are subcontractors who are working for your company, but they don't sit within the UK, so they're not individually paying tax in the UK, then possibly those are going to be excluded. And that could have a big impact, particularly in relation to claims around IT. So building applications to use on the internet, platforms, which we see a great deal of, blockchain, all those kind of things. There is an awful lot of expertise overseas in terms of just numbers of people and the size of workforce that can do the testing for companies that are sitting in the UK. We deal with a great many claims where there are big teams of people working in India. I mean, it's no coincidence, is it, that there are a lot of call centres and outsourcers also sitting in India. There's a very large population and they're all very skilled, very educated people. So that could have a very serious impact on claims in the UK ultimately. I suppose it could mean that people either can't afford to carry out the work because they need the R&D credit from the tax system, or they just have to go ahead and don't get the tax credit. That is speculation, but that does seem to be the way that the thinking's going. So there really is a watch this space on that one. And if you are going to be involved in the project and you can start to source more people in the UK, that's something to be alert to. They did talk about including data and cloud computing costs. Again, we haven't got a definition of precisely what that means as opposed to the IT consumables you claim anyway, but a bit of change coming on R&D. Another announcement in relation to capital allowances. Earlier this year, we saw the introduction of the 130% super deduction for companies, and the AIA limit was lifted up to £1 million, originally due to finish at the end of this year. But yesterday, the Chancellor announced that that would continue until the 31st of March 2023. So that's the same deadline for change as the super deduction exists. So basically just align those two. But essentially that's good news if you're about to make a great big capital allowances claim.
Another area that the Chancellor touched on was business rates. Obviously, there's been a lot of relief and grants over the COVID period to cope with the pandemic in respect of business rates. So business owners with high street properties were waiting to hear what the Chancellor was going to announce here. It's important to just advise as well that the business rates only apply to England, but the other governments of the UK will receive funding under the Barnett formulas, so they will be almost certainly releasing their own schemes to reflect the additional funding that they'll also be receiving under these reforms. Also, the High Street was told that the government are still exploring the idea of a UK-wide sales tax, but the Chancellor did mention that business rates raise for the economy around £25 billion a year, and they were unable to immediately make any changes because that's just too much money for them to be able to reform instantly. But there did seem to be a promise that over time a UK-wide sales tax would be applied to give a bit more fairness to the system so that online retailers face the same sort of costs on their premises as traditional brick and mortar businesses. So some promises for future reform and some temporary relief was also announced. One of the most important announcements was that the revaluations would move from being every 5 years to every 3 years to make the system fairer. There was also an acknowledgement in the budget that certain sectors had been more hit than others. So for the retail, the hospitality and the leisure sectors, there was going to be a 50% reduction in rates up to a maximum of £110,000 in 22-23. So for those sectors of the economy that have been hardest hit by the pandemic, there will be some additional relief. Business rates for investments in green technologies, there would be a new business rates improvement relief. So this will be something that they will give more details on, but for businesses with premises that make investments in green technologies like solar panels and other green technologies, they may be able to not pay additional rates for up to 12 months as a result of making those investments, but we don't have all the details yet, so we'll bring you those once we've got those through. Transitional relief for small and medium-sized businesses will be extended for a year as well. And this will restrict bill increases on the property, and the restriction is based on the rateable value of the premises. So all in all, there was some positive news there on the business rates front, and some promises to look at reforming the system to make it more fairer in perhaps the longer term. Another welcome announcement for businesses was the extension of the recovery loan scheme. We've had many iterations of loan schemes, bounce back loans, C-bills and many others to try and support the economy through the pandemic. And although we're now moving into a firm recovery mode, there was still an acknowledgement that there may need to be some loan support. So the recovery loan scheme was extended until 30th of June 2022, but there were also some reforms announced so that from the 1st of January, a number of new changes will be introduced. The scheme will only be open to small and medium-sized enterprises. The maximum amount of finance available will drop down to £2 million per business. And the guarantee coverage that the government will provide to the lenders will be reduced to 70%. As with all loans, you'll still be 100% liable for the loan, but the government will be on the hook for an amount to the lenders, and that will drop down from 80% to 70%. And the above changes will apply to finance applications from the 1st of January 2022. So for businesses that are still struggling, there was some good news on the loan front. There was also some minor changes made to the capital gains tax regime. As Diane said, the budget was very light on new announcements for tax, but there was a welcome change because at the moment, when you're a second property owner, so if you're a landlord or you need to pay capital gains tax on a residential property and you're a UK resident, you have 30 days from the completion date to do a 30-day CGT return and pay tax. From the budget day, that's changing and it's being extended to 60 days. Obviously, 30 days from completion, people are under a lot of pressure when they've sold properties potentially, particularly if it's one that they're currently living in. So although this doesn't affect people that are fully exempt from property taxes, so if you're selling your own home, it's not necessarily something that you're looking at. It is for people that have to actually pay tax when they're UK resident. That is a very welcome extension. If you're a non-resident, you always have to make a declaration of disposals of all UK property, and they will benefit from the same extended time period. So that from 30 days to 60 days will be most welcome from landlords. Another announcement was that there would be some relief a little bit in the future for some lower paid workers who are currently missing out on pension relief. And it's because of the way the pension systems work. You can get relief under a number of ways when you make investments into a pension. Typically, if you make a personal pension payment, for every £8 that you put into the pension, you get the basic rate of tax relief also contributed from the government. So the government would contribute for an £8 contribution, another £2. But for certain low paid workers where their relief is taken in another way, they're missing out on valuable tax relief. So the government is going to reform that in the longer term. It was an anomaly that's always been in the system, and the government in their 2019 manifesto had pledged to correct this, and that now looks to be set how they're going to reform it. I suppose the speculators, whenever it comes to budgets, always look at potential tax rises. And as Diane said, there've been speculation on wealth taxes, inheritance tax, capital gains tax. None of those changes really came about, and it was quite benign for those taxes. But pension relief has always been looked at in budgets, and in over successive years, the amount of relief that you can get when you're making pension contributions has been steadily eroded. There's been no changes in this budget to that, but perhaps it also indicates that where they were looking to attack certain ways to make pension contributions through salary sacrifice, perhaps they're not looking to do those now because they are making reforms in another way to make the system fairer.
So there were a few other changes that we won't mention today. There were things like residential developers tax, but that affects companies with profits over 25 million. So that kind of measure we're not terribly interested for our client base on the whole. There were things about diverted profit tax and migration of companies back into the UK. But we thought we'd end on a bit of good news. So two things here. The fuel duty rise was scrapped for 22-23, given the sort of somewhat eye-watering price of fuel at the moment. That's obviously good news. And there are also quite a few points on alcohol duties. There is generally a reform to the way alcohol duty is assessed. There is support for craft manufacturers. That's probably not the right word in the context of craft drinks, but craft beer, craft cider. So there's some improvement in the situation for them. And for lovers of Prosecco, the alcoholic content is now going to be the driver for the duty. So things like rosé, sparkling wines, cider, the price may actually go down slightly. I think there was talk of a pint of beer going down by 3p for lower alcohol content beers. So at least we can end on some positive news.
Exactly, yeah. And going on from that positive news as well, there was a statement made by the Chancellor yesterday, which hopefully he will stick to, which is that he did acknowledge the very steep tax increases which have been introduced over the last few months. And as Diane touched on, big increases to national insurance, big increases to dividends, and before then announcements that corporation tax would also be heading upwards. But the Chancellor did also say that his goal is to reduce taxes, and by the end of the Parliament he wants to see taxes going down. So for many business owners that will also be good news, and hopefully now allow us to start planning so that we can start looking at how these tax increases are going to affect us over the medium term, and taking the action that we need to do. But hopefully looking forward to no further massive changes or increases to tax rates. So thanks very much for joining us. If anybody does have any questions, please do put them through. If we don't get to them now, we will get back to you. I think that's it from us. So we hope you've enjoyed this breakfast webinar, and we wish you a good day for the rest of the day. And thanks very much for joining us.